Hello everybody, welcome to Monday Market Must-Knows. My name is Merlin Rothfeld, and here are 3 things to pay attention to for the upcoming trading week. The first thing we're going to talk about is one we normally don't talk about, which is bonds. We're talking about the U.S. Treasury Department, to be specific. Now, why would that be so important for most of you who don't even trade bonds? Well, there's 2 announcements coming out this week that you want to pay attention to for a couple particular reasons, which I'll get to. First announcement is going to be Tuesday at 1:01 p.m. That's right. Gotta love the Treasury to just mix it up. 1:01, don't be late. That's the 10-year bond auction. And on Wednesday, we have the 30-year bond auction at the same time. Now, why is this important to you? Well, first, let's look at the U.S. federal debt. We're going way back, I know, way back into 2007. And the first box I want you guys to draw your eyes to is that blue box, which is the recession, the financial crisis that we had from 2008 to 2009. Now, at that point, it was the end of the world, financial collapse. Our system is collapsing. Oh no, the sky is falling. We did quantitative easing 1, quantitative easing 2, quantitative easing 3, Operation Twist. So much money was pumped into our economy. You can see it reflected on the chart, right? It went from right around $9 trillion to upwards of about $12 trillion. That's a pretty big spike. But lo and behold, hold my beer. Let me show you what we can do in 2020. Check this one out. Look at the spike. The acceleration is incredible here in what we saw in 2020. It went from roughly $23 trillion to now we're over $27 trillion in a very, very short window of time. Now, why is this important? It's important because the 10-year yield, which is a reflection of that bond auction, is what your mortgages are based off of. If you have a 30-year fixed mortgage, it's usually based off that 10-year note. Now, it's important also because we've been at historic lows. You can see that chart has been falling and falling and falling till right around March of 2020. Now, it bottomed out there at 0.4%. That is a historical low, 0.4%. But in the next few months, we've seen it rise significantly. We've seen it rise 150% over the past few months going into 2021. Now, this is important because that means that the price of these bonds are going to be dropping, meaning yields are going to be rising. Now, because we've incurred so much debt, I mean so much, trillions and trillions of dollars worth of new debt. It was $2.6 trillion just for the stimulus, also about $1 trillion worth of tax relief. That money has to come from somewhere. It's coming from the government. Now, what do they need to do? They need to pay the interest on that debt. Where are they going to get that money? They sell bonds. They sell 10 years and they sell 30 years and they also sell 20 years and other maturities. Now, because there's so much that needs to be paid, they have to sell much more of these 10 and 30-year bonds. When so much more supply comes onto the market, what happens to the consumers? The consumers go, well, there's a ton of it here. I'm backing away. I don't want any because there's a flood of it. In order to entice people to buy these 10 and 30-year, the yields will be rising, as we've seen over the past few months. Now, we're right now at about 1.1% on that 10-year, so you can still get your 30-year fixed relatively cheap, right around 3%. But what if this sale of bonds is colossal and much more comes to market and all of a sudden yields spike to 1.5%, 2%, 3%, 5%? This is obviously something that's maybe coming down the road, but it's a sign that trend may have reversed for low rates. Higher rates choke the economy a bit, so we'll see down the road how that transpires. But right now, those bond auctions coming out on Tuesday and Wednesday, you should pay attention to those. All right, next one on our list is going to be retail sales numbers. As we've seen, COVID has created all kinds of volatility in the retail sales market. It has been slowly dropping for the past 6 months. And what's noteworthy is we finally passed the Black Friday Thanksgiving sales, the Christmas Santa Claus rallies, and now we're in January and things are really going to start to slow down. The expectation is we're actually negative 1.1% on retail sales, meaning a contraction in retail sales numbers as Americans hunker down and stop spending money. This is important because, as we know, spending drives the economy going forward. That announcement happens Friday at 8:30 Eastern Standard Time. And finally, tail end of the week brings us to earnings calendar. It's a boring week. I mean, there's only 44 companies reporting earnings. You notice over the past few weeks, it's maybe 1 or 2 big names. Well, it's a snooze fest for most of the week. On Tuesday, we have KB Homes. You also have Delta Airlines, which that should be a wild one. On Thursday, you have BlackRock. And I'm going to highlight everything that's a financial firm in green. Now, Friday, it's off to the races. Let's get ready to rumble! Earnings season kicking off officially. JP Morgan, Citibank, Wells Fargo, PNC Financial. These are 3 or 4 monster financial firms. Now, why is this so important to you and me? Well, because first off, it kicks off earnings season. This is an exciting time. For the past few weeks, all we've had to focus on is the political chaos that's going on in America. That creates a lot of volatility in the market. Now, what helps is when we have a sense of direction. As earnings roll out, we'll get a pulse on the American economy and how are these companies doing financially. If these financial firms report very well, we could see this rally continue. If there's disappointment and for some reason these financial firms miss expectations or lower forecasts going forward into 2021, we might see this market stall and reverse to the south side. Bottom line is we have something new to look at other than our elected officials. We'll see you next week for Monday Market Must Know.